Thank you, Mr. Ferrari, for your introduction. It would have been great to meet all of you physically in Geneva, but actually it was not possible, as you know. And anyway, since I'm talking about the virtualization of a management community or a management team, a virtual presentation fit well the occasion too. Of course, I'm just joking. So sad for this, but we have to go on. So let me share the screen and start my presentation. Okay. Here we are. I'm nice to virtually meet you. And first of all, let me introduce myself and my company. I founded Redex Risk and Finance about 12 years ago in 2008 as a spin-off of an asset management company. And our mission is to use physical science for asset management and portfolio management. You can find more details in our website, www.redex.net. Just type Redex in your browser, and you can see everything about our business. So, I'm going to skip the press review, Il Sole 24 Ore, Milano Finanza, and I'm going to skip the scientific publications too, the MAF2020, and Financial Markets and Portfolio Management Springer, just to go straight to the point, our game-changing robo-management framework. We coined the term robo-management to define an application we have developed in the field of asset and portfolio management. It regards the virtualization of an entire asset management team, including the asset manager that becomes a robo-manager, the analyst that becomes the robo-analyst, and so on, transforming each human subject into a software object, say a robot. Before going into the details, let me skip to the conclusions, the advantages of this approach. First of all, an investment team is very expensive and it might cost more than 50 basis points. Our robo-management, being a software, reduces the total management costs here for more profitable risk-reward ratio for the investors. Then, it is not possible to backtest a human investment team, whereas it is very easy to backtest a fully virtualized investment team. Remarkably, the major part of the investment strategies actually used by our clients in their investment committees have shown to be faulty in the backtests, but about 10% were okay. So we work on them till we have the expected result. Furthermore, a human investment team can manage very few portfolios, so they are usually clustered together to serve many investors. On the other hand, in our framework, it is easy to customize all the investment parameters for each portfolio and investor. Last but not least, psychological biases affect human decision. Think at framing, greed, risk aversion, time frame shifting, and so on. Whereas in our framework, every decision is taken offline without any market pressure, so reducing all the psychological biases I told before. Now, let's enter into the details using a real case example regarding the active management of a global macro investment certificate. We have two phases, and the first phase consists in the setup of the investment vehicle. First of all, the investment philosophy here has to be fully identified. For the aforementioned certificate, the investment vehicle aims to achieve a middle long-term return above inflation through an exposure to the real economic growth, limiting the downside risk using portfolio diversification and an active management style. Given this guideline, our client coherently decided to invest in a widely diversified global macro investment universe, ETFs and futures listed on a regulated market, although in long position only and keeping the financial leverage below 1. The benchmark has to be set according to the previous points and the target investors. For the certificate here, it was decided to use the Indice Fideuram Flessibili Netto, the index representing the flexible funds available in Italy. And finally, costs are a major parameter which will directly enter into the model. The total expense ratio of the certificate is set to be less than 1%. Once all the general requirements have been defined, in the phase 2, we set up a first working version of the framework here. And then all other parameters here are fine-tuned through backtesting, as we will see right now. So let's have a closer look at the software objects in the virtual committee and their relation. The first software object we present is the time object. It is not uncommon to see trading and investing platform mixing the past with the future in and out of sample data. So we decided to create an object that is in charge of isolating each investment committee, cropping out all the information not available at the virtual committee date. This is the point. In this way, time consistency is not delegated to the objects in the frameworks themselves, exposing to errors, but it is guaranteed by a dedicated object. Time object ensures that all the results are reliable and close to reality. Then we have the robo-management. The robo-manager is the object in charge of defining the final asset allocation. It iterates through many different candidate portfolio here. Each candidate portfolio is given to all the other objects here, collecting their response. Then an optimal function is used to evaluate the responses and assign a rank to the candidate portfolio. In an iterative process, the optimal function is maximized and the final portfolio is obtained. The robo risk manager here, is the object in charge of measuring the risk of the whole portfolio and verifying all the risk exposure constraints. It is possible to use many risk measures. In particular, we strongly suggest to use our RED-ES risk measure. So what is RED-ES? Well, let's start from the problem. As we know, the widely diffused normal statistics here in violet is not able to correctly describe the distribution of financial returns here in gray, in particular in the tails. In a human committee, the inaccuracy coming from an incorrect risk measure is compensated by the intuition and the experience of the asset manager. For example, during low volatility regimes, typically in the bullish phases, the asset manager will not increase the risk exposure just to fit the target risk, symmetrically in the bearish phases. Unfortunately, in a quantitative model, it is not easy to simulate such human feel, and it is necessary to use a more precise and coherent risk measure. So I'll skip all the detail, but just say that we developed RED-ES, a risk measure built on a Pareto-Levy stable statistics here in light blue, exactly to solve this problem. If you are interested, you might read the paper cited here, And if you want, just write me an email or message me to have the link to download it. Back to our robots. We find here the robo-analysts that are in charge of estimating the expected return of a given portfolio. Our clients can freely set up every robo-analyst using technical indicators, fundamental indicators, and analysis, or any quantitative programmable combination they want. Actually, what we require is that they just provide us a time series indicating the analyst sentiment for each financial activity in a range from -1, extremely bearish, to +1, extremely bullish. In the real case studied, our client decided to use a very simple trend following model based on 2 exponential moving average, 1 and 2. Analyst position is 1 is the faster moving average is above the slower one, and 0 otherwise. The lengths of each moving average are optimized before every virtual committee using this chart. And then here it is the robo-compliance. Robo-compliance verifies all the investment limits, including minimum and maximum exposure for each asset class. The limits for aggregated asset class, for example, equity, bonds, and so on. Turnover limits, and many others. Robo-broker then, here, simulates the real investment, including management and performance fees, high water level mark, transaction cost, spread, and slippage. Finally, we have the robo-auditor. It works ex post. And indeed, it takes the simulated NAV here, you can see the simulated NAV, and compares it to an attended probability field that has to be defined a priori with the client. See this figure. Note that this tool is useful not only to monitor the management results ex post, but also to represent an agreement with the investor on risk, potential return over time, and the best investment time horizon before investing. And so, in the end, this is a typical investment committee where the robo-manager allows a discussion between all the attending robots, taking the final decision. Now, to see the results, I'm going to connect to our production server just to show you the most updated data. So let me connect to my server here. Okay, and start. Scrolling down on the code, we find here this chart. Here we have summarized the final portfolio allocation coming from a Robo-manager. As you can see, after the COVID shock, the allocation here changed deeply to reflect the new market conditions. Almost all the equity part of the universe is not present in the final allocation. And this is the last portfolio allocation, the details of the last portfolio allocation, where the major weights are taken by here gold, the first one, and silver, the second one. Then we have corporate and government bonds, and wow, we have NVIDIA here that stands in the top 10 position. And actually, as I told you before, the equity part hereafter is 0. The turnover here is about 250% yearly. And then scrolling down, we are going to the performance that is supposed to be, of course, the most interesting thing. Let's scroll. And okay, here it is. Here we have the performance. You can see the gross NAV here in light blue, and the net NAV here in blue, together with the benchmark here in gray, and the index of Fidelma flexibly I told you before. Then scrolling down, I'm looking for the robo-analyst's position chart. Well, sorry, I have to calculate it again. I don't know why, but let's do it and wait just a few seconds to have the chart. Okay, here it is. Here we have the chart. So in this chart, we have summarized the robo-analyst's position on each financial activity here on the right. So we have the time flowing here and the financial activity here. A blank stripe, for example, here, 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 and so on, means that the analysts are negative or neutral on such item. Then scroll down again, and we find the red cone I told you before. The red cone is calculated ex post by a robo-auditor, as I told you before, and actually we are now on the target zone, on green, despite the COVID shock. Hope to continue in this way. And finally, some statistics.
2 minutes, Riccardo, to the end of session.
Yeah.
Thank you.
Okay, I'm finished, because I just want to show you a couple of statistics. For example, the average return of the gross NAV here that is about 17% yearly, and the volatility that is quite high but controlled, about 13% yearly, and finally the Sharpe ratio that is 1.29. Okay, this is it, Emanuele, this is it. Thank you for your attention, and of course I'm here for any questions.
Perfect in time, Riccardo. Thank you for the speech. Any question? Okay, Riccardo, I have one for you.
Yeah.
You have seen the benefit of your model on the cost reduction.
Yeah.
How this is reflected on the investor choice, please?
Yeah, this is a very interesting question because cost reduction has many non-trivial implications. For example, there are a wide number of active managed products that perform below their benchmark just because of costs. So reducing costs, we increase the number of profitable strategies available to investors. But there is another not so obvious consequence, that is reducing costs. You will reduce the investment risk in the long term too, having a more favorable risk-reward ratio.